Hello, this is Ernest Osias, Director of Market Analytics with Woodall Risk Management. Thank you for joining us for our weekly technical overview of the grain markets. Before we begin, a brief moment to look at our market disclosure. This is a solicitation, and there is substantial risk of loss in trading futures and futures options. Past performance is not necessarily indicative of future results. Thanks once again for joining us for our weekly installment of the Technical Market Overview. We'll go ahead and begin. The new year is upon us, and not much has changed from our end of the year market update. As we can see, when we left off, the market was at resistance near 362.5. From that point down, for about a week, the market made its way back down, testing support at 343 3/4. And the new year has kicked off with a little bit of strength, and we're making our way back up to resistance near 362.5 again. Now, this time, as we can see, the market has tested at 362.5 level a number of times. And now that we're approaching it, if the market's able to break through and perhaps give us a close about 365, it would not come as a surprise to see the market come up to about 372 and possibly as high as 382, depending on the strength with which it's able to move. Market was last seen as being oversold, and it's now making its way back up to being overbought again. So long as the percent K and percent D are pointed upwards, we believe that the market could have some potential strength here. The market is a truncated week, and so we only have 4 trading days this week. So over the next 2 days, the market is perhaps looking to move up into that Friday timeline and perhaps pause there. We're looking to see if it's able to continue with strength. From this perspective, we can see how the holiday low came in spot on with the 347, 50% retracement level that we had projected from 2 weeks ago and prior. The market continues to make its way up. And again, from this perspective, we have previous highs coming in at 369 for potential resistance. Point of control level, or at least one standard deviation below the point of control, sits at 360. And so at 360, again, is where we're looking to see some potential resistance on its way up. Again, a close above 365 would be an indication of potential continued strength. In our newsletter that we published yesterday, we pointed out that soybean was poised to have a potential move to the upside off of support. And it's done exactly that, right in line with a potential timeline turn with this vertical point here, where we have some trend lines coming in, and those intersection points will often point to a potential turn in the market. Since the market turned down into this move, we're looking for a bounce, especially since the market had come in and was oversold for quite some time. The market had been down through the holiday. We had one big bounce on Tuesday of last week, but that was short-lived, and the market has since given most of that back. That move to the upside was basically on the heels of news from Argentina from what was perceived to be beneficial rains, but then the rain looked to be excessive. And once the rain cut back a bit, the market returned to weakness again, as the rains did in fact turn out to be beneficial. The market has moved down into our timeline and is now turned back up. And so what we would be looking for now is to see whether or not the market's able to trace up this natural trend line that we have here in a similar fashion to what it did on the way down. Key support continues to rest at about 1,003 to 1,004, and this is where we're seeing some very good market congestion, or at least some good market support. The market has made its way back up above this level, currently trading at about 1010. The point of control for this March soybean contract rests at 998.5, which is essentially where we're seeing key support come in. So as long as the market's able to continue to hold the support after being oversold is going to be key for a potential move to the upside. Overhead resistance now rests at 1020, and above 1020, we're looking at 1036. Above 1036, then we should really see a test of the previous highs going up to somewhere in the neighborhood of 1070. The move that we're seeing from the March wheat contract has been very impressive. 2 weeks ago, we shared how the area of 386 to 395.25 was really going to be the make or break region for this contract. Right now, what we're seeing is that the market made a low early in December, and then late in December, we see a higher low that did not exceed that previous low. As long as this market is able to continue to make higher lows, especially if on the next move up, we're able to break this previous high, come back in, make our higher low somewhere near one of our pivot timelines, we could very well be in for a very fast break or a big move to the upside, so long as he's able to continue making a sequential higher lows. If he makes a higher low in mid-January, perhaps near the USDA report on January 12th, followed by a subsequent higher low, statistically what we have found is that the market is prone to making very big explosive moves off of that next sequential higher low. Right now we're sitting at key resistance near 411 and a quarter. As long as we're able to close above this 411 and a quarter number this week, that does bode well for this contract. And next week, we're looking to see if we're able to penetrate or get through this 420 level. An additional note here, you will see how the market came into our sinusoidal wave. This is where it found support over the holiday and was able to move up from there. From here, we're seeing a nice bit of a consolidation, kind of a P pattern where the market is now broken up to the upside. Again, it's holding above this 411 and a quarter number. We are also up against volatility-based support. So now that the market has come through and is now sitting above this volatility-based support region, this area continues to be very strong for him. And as we're looking at this market now, again, this 420 mark is the next key area that we'd be looking for key resistance for the market to get through. In closing, we'll have a look at the March crude oil contract. We still continue to like the 5-wave sequence that this market posted over the course of the past few months. As it's come in, we're looking for potential ABC to come in where we initially had our B coming in where we have this circle here for another potential move to the downside. Instead, what we're seeing is a more traditional consolidation across the side here. And what could happen is one of two things. This big move that we saw yesterday to the upside ended up failing and giving us a big sell-off at the end of the day, but it did not exceed the previous wave 5 high. So one of two things can happen now. If the market is actually able to get above this previous wave 5 high prior to breaking 51, then this wave 5 would be shifted over to the next high. If the market's able to break down and breaks down and touches somewhere in the neighborhood of 50, then we would have a nice ABC correction confirmed, at which point we will be at a space where we have a potential for a long for the market to move back up again. If the market comes in and makes a new high prior to breaking that 50 once again, then we'd be looking for more a dramatic or a stronger move to the downside, as this move that we're seeing here is perhaps distribution as opposed to accumulation for the market to move higher. Again, where he actually breaks first is going to be key. For now, we still do like the count, but this market right now is essentially consolidating or is in the midst of a distribution after having had a very big move to the upside from the middle of November through the end of December. Thank you so much for joining us for our weekly market update. Hope you had a fantastic holiday. Happy New Year to you. Look forward to touching base with you again next week.